Let me ask you something. How many of you watching this right now think the stock market is only for rich people or financial experts? Because if that's you, I'm about to change your mind completely. The truth is, the stock market is one of the most accessible wealth-building tools available to everyday people. And the best part? You can start with as little as $50. In this video, I'm going to break down the stock market basics so clearly that you'll actually understand how it works, why it matters to your financial future, and exactly how to make your first investment by the end of this week. Let's start with the fundamentals. What actually is a stock? A stock is simply a small piece of ownership in a company. When you buy one share of Apple, you literally own a tiny fraction of Apple. The company needs money to grow, so instead of borrowing from banks, they decide to chop themselves into millions of pieces and sell those pieces to regular people like you and me. You buy a piece, you own a piece. It's that straightforward. And here's the beautiful part. If that company becomes more valuable over time, your piece becomes more valuable too. That's how wealth is built in the stock market, not through luck, but through owning pieces of successful, growing companies. Now, how does the actual stock market work? Think of it like a giant marketplace where millions of people are constantly buying and selling stocks. The price of each stock moves based on supply and demand. If lots of people want to buy Apple stock and not many are selling, the price goes up. If everyone wants to sell and nobody's buying, the price goes down. This happens thousands of times every single day during market hours, which is why you see those dramatic price changes on the news. But here's what most beginners don't realize. If you're investing for the long term, we're talking years or decades, those daily price swings don't actually matter. What matters is the overall trend over time, and historically, that trend has been up. Why does starting young matter so much? Let me give you real numbers. If you invest $10,000 at age 25 and never touch it, assuming an average annual return of 10%, by the time you're 65, that investment will have grown to approximately $452,000. Same $10,000, but you waited until age 35? You'd only have about $118,000. That's a difference of over $300,000 just because you started 10 years earlier. That's the power of compound interest. Every single year your money grows, and then your growth grows too. Albert Einstein literally called it the eighth wonder of the world, and he was right. So how do you actually start? There are 3 beginner-friendly approaches. First, you can open a brokerage account with companies like Fidelity, Charles Schwab, or Robinhood. These apps let you buy individual stocks with just a few clicks and minimal fees. Second, you can invest in index funds or ETFs, which are essentially pre-made packages of stocks that spread your risk across hundreds of companies. This is honestly my top recommendation for beginners because you get instant diversification without needing to pick individual stocks. Third, many employers offer a 401k with matching contributions. If your employer will match your contributions, that's free money, and you should absolutely take it. That's a guaranteed return before the market even gets involved. Let's talk strategy for a moment. For beginners building passive income, consistency beats perfection every single time. You don't need to find the next Apple or Tesla. You don't need to time the market perfectly. What you need is a simple plan. Open an account. Invest a fixed amount every single month, even if it's just $100, and reinvest your dividends. Do this for 20 years, and statistically, you'll have built serious wealth. The stock market averages around 10% annual returns historically, which might not sound exciting, But that compounds into life-changing money if you stay patient and disciplined. Here's your action plan for this week. 1. Open a brokerage account. Pick any of the big ones I mentioned. They're all solid for beginners. 2. Fund your account with whatever amount you're comfortable with, even if it's just $50. 3. Buy a simple, low-cost index fund that tracks the S&P 500 or the entire stock market. Don't overthink it. 4. Set up automatic monthly investments so you're consistently buying more shares. And 5. Promise yourself you won't check your account every single day. That's how people panic sell during market downturns. Check it quarterly, rebalance once a year, and let compound interest do the heavy lifting. Quick reminder, this is educational content, not financial advice. Do your own research, understand your risk tolerance, and if you're nervous, talk to a qualified financial advisor. But here's what I know for sure. The best time to start investing was 20 years ago, and the second best time is today. The stock market is how ordinary people build extraordinary wealth, and now you understand the basics. If this video helped you, smash that like button, subscribe for more personal finance content, and drop a comment telling me what you're investing in or what questions you still have about the stock market. Let's build wealth together.